They
Music.
said it
But
couldn't
stop
be
the
done.
music. Before we start anything, we have a new addition to the pirate ship. Corey Hofstein is now a proud father of a baby pirate. And I just want to say mazel tov before we get started. Like, that's incredible.
Thank you.
Congratulations to you
Thank
and your new family.
My mother even bought me some pirate-themed sleepwear for the baby.
She
So we're
already beat
going
us
all
to it.
in.
Tyler and I were already texting about that. We're trying to find sources, but yeah, it's
We're going all in. Look, they said it couldn't be done. They said I wouldn't make it to the show. I have skipped every other obligation in my life this week, except this one. That's how much you and the Booty Crew mean to me.
I appreciate it. I was texting you like, no worries, man. I'll do an AMA episode or something like that. But also at the same time, does this give you a nice respite where you can be like, sorry, honey, I got obligations?
No, I think my wife's going to kill me. I'm definitely going to pay for this one in the future. We're making bad decisions, bad family decisions out of the gate, Jason.
Speaking
of the
bad
father you want to be.
Bad family decisions is do not take investment advice from these two idiots on a Friday on YouTube. This is not financial advice. It is for entertainment purposes only, and we hope to entertain. That's our goal in life. Not always fulfilled. Go ahead.
I was just gonna say, even in prime condition, when I'm well slept and well rested, you shouldn't take financial advice from me. But definitely don't do it when I've gotten a cumulative 5 hours of sleep and you can see my eye twitching on stream.
And I think in general, you shouldn't take investment advice from anybody on the internet. Do your own due diligence. But also on that same vein, man, you think we normally don't talk about finance. With you being at the hospital pretty much all week, this is going to be a very finance macro heavy episode for sure.
Which is kind of funny because I do think a lot of finance stuff happened this week that I have no idea what happened. Like, I'm just like, oh, a bank failed today, huh? Oh, a crypto bank failed sometime this week, I guess. There's all this crazy stuff happening that I am just, first of all, I don't even know what day today is. I don't even know if markets are open. I assume it's Friday, given we're doing this show.
So, well, speaking of giving you the heads up and hit your checklist, do you have your light handy? Just because my white balance is, I'm getting direct sunlight, and I just don't want us to be so dramatically. But I understand if you'd rather be in darkness, given the bags under your eyes.
My light is on, and I'm sitting in front of a window, so I don't know what to tell you.
One of these days, we'll figure this out. So, by the way, you see Brian's comment. Sorry, honey, I can't watch the baby. I have to go be with a pirate with my internet friends. That's so good. So I will fill you in a little bit. Not that I have any hot takes or anything going on, but obviously Silicon Valley Bank is something close to me, so to speak, both in proximity and philosophically be in the Bay Area. But basically, you've had, like you referenced, there was multiple things went on this week at the same time that Silicon Valley Bank was trying to raise assets, because once again, deposits are a liability for the bank, and then they go out and purchase assets, and you have to, you have to balance your assets and liabilities, and a lot of times the duration can be mismatched. And we have what we call a liquidity cascade, TM Corey Hofstein. And these are what happens in a bank run. And my favorite part was like by the way, it was also coincidental with, or maybe not coincidence, just par for the course, is like you said, Silvergate went through a voluntary distribution, basically a voluntary shutdown this week on the crypto side. So how much was Silvergate both on the crypto side and then probably jumping over into the VC side? So you're seeing a cascade from these banks that have helped out VCs, whether that's Silvergate, now we're seeing with Silicon Valley Bank, and then it's kind of cascading into over other California banks like Signature and First Republic, that people are really worried about that. But at the same time, as everybody knows, since the GFC, like the banks are really well capitalized and everything. So we'll see how regionally effective this is, or is this the camel that breaks the straw's back? And I can go into a little more detail, but I'll let you jump in here.
Yeah, I'm curious if you happen to know. So I assume this is a basic, they've got short-term liabilities from the people who are depositing, and they were investing long-term, and then rates went up, and those long-term liabilities got marked way down. And then it became a question of, could they actually meet the withdrawal needs? I saw something crazy, like it was like 90% plus of the assets aren't FDIC insured, because you only get what, 250 grand. And so it's like a huge proportion of assets are not FDIC insured. Their balance sheet got catastrophically ruined. But none of that is really a problem in theory, unless everyone decides to take their money out, right? And then you get the classic bank run. And so once you get the bank run, then the balance sheet completely falls apart. If I'm not mistaken, the government actually seized them this afternoon, right? Did I see that?
Yeah, no, that's the breaking news, by the way. And you and I haven't dove into this nearly as much as anybody else would. Like Brian Moriarty in the comments saying they bought MBS in a rising rate environment and didn't hedge, which is always an issue. But part of that, like, yes. So the breaking news was earlier today that FDIC came in and at least put part of Silicon Valley Bank into receivership. And then for the insured deposits, like you're saying, up to 250K, they said there'll be access to that money on Monday. So that's pretty amazing from Friday to Monday. And then the uninsured deposits, like you're saying, above 250K, which is going to be the majority. And I didn't realize the number was that high. So you knew more about it than I did. Is that uninsured deposits are going to start getting a dividend as soon as possible, and then they'll just start sorting through the wreckage. But part of it was
so who's the knock-on effect, right? So this is a huge amount of startups put their capital there, right?
Right. And so what was interesting is I think it was Fred Wilson came out and was like basically telling their portfolio companies to take their money out of Silicon Valley Bank. At the same time, the CEO of Silicon Valley Bank was saying, let's keep calm and carry on. We'll be able to get through this. And, you know, it's one always, if a bank tells you everything's fine is when you should be panicking. But at the same time, which I thought was great, he was like, oh, you remember during like the pandemic when we helped all the VCs and our portfolio startup companies get through that? Yeah, maybe we could use some reciprocity here. And then, of course, everybody's like, nope, let's get our money out as fast as possible. And what they're also pointing to is like the deposits have just been being sucked out because the startup companies are just burning through capital. But they did say the VCs, for the most part, have been just sitting on their dry powder in Silicon Valley Bank. So we'll see, you know, if that's true or not. But to your point, what's the cascade of consequences? Like, to me, like this is one of those knocking on the door, or maybe looking back in hindsight as the first salvo for you know, private equity VC, kind of where their mark to market, you know, how their mark to model is going to change because it's really showing up in the banking system that services these clients.
Right. Kind of interesting that I'd say it's ironic, right? It didn't have to be this way. Silicon Valley Bank didn't have to take this type of risk, right? There's no need for it. They could have just held like tier one assets and could have been fine, right? But it's kind of ironic. Everyone's talking about it was the low interest rate environment that enabled the excess of Silicon Valley. Now you've got the high interest rate environment, increasing interest rate environment. One of the first major casualties is the bank of Silicon Valley. So that's kind of funny. Again, didn't have to be that way. The other sort of ironic thing here, especially when it comes to banks and their CEOs, right? You go back to that word credit, and the origin of credit, I believe, is Latin. And it means belief and trust, right?
Right.
And that's what, like, the banks are sort of this funny animal where their durations are often not perfectly matched, and you would hope they have plenty of tier one capital to meet those withdrawal needs. But at the end of the day, like, I'm not sure any bank can actually survive 100% bank run. Like the capital is just not all there, and so it's a question of what sort of bank run can you stand up to. But I mean, as a startup, how many startups use Silicon Valley Bank? That's like the classic. So how many of these startups aren't going to be able to meet payroll, are going to go under, or is someone just going to buy out all the assets? And, you know, is JP Morgan going to do it? Is Warren Buffett going to get a call?
As you and I, we frequently talk about is like the, you know, averages don't apply. And that's what I was saying. The banking industry, you're looking at your cap ratios and you think, okay, an average day or month or year, these are how many people are going to withdraw their deposits. And you cannot handle a bank run because it's fractionally reserved. And so it's always kind of interesting to see these watch. What I was also thinking about today, though, is like in the 99, 2000 blow up, you know, it didn't really affect the greater economy because it was more of an equity bubble. But what you're finding out now with like Silicon Valley Bank and everything is like almost in a, I'm always going to use it, Hyman Minsky sense that like everybody, you know, didn't lend to startups in the 90s. And now because of the full advent of startups and the startup ecosystem at Silicon Valley Bank coming in to service them, they have a lot of debt on their books to startups as well. And so this is kind of a newer phenomenon. So I don't know how much that creates a cascade of consequences or not, because it's not necessarily just an equity bubble anymore. It seems that debt levels are fairly low, but there's still more debt on startups, which, you know, technically you just, you know, shouldn't make a lot of sense, honestly.
And sorry, I'm pausing. I can literally hear my child screaming in the room above me.
New life for Corey.
I'm like looking at my phone, just waiting for my wife to text me, being like, "Get off your stupid show."
Yeah. So so if you have to go, you have to go, and I'll figure it out. Do AMA with the booty crew, which will devolve into a disaster probably immediately. So yeah, who's gonna step into this? Obviously, so Silicon Valley Bank was trying to raise capital. They apparently, that didn't happen. It was once again, the lady doth protest too much, and everybody ran for the exits, and they had a bank run, so that didn't work out. So
So
at the
here's
same
the
time,
funny thing to me though, like this whole like raising capital. If you are actually interested, aren't you better off just letting the asset fail? Like you're just going to get a better deal. So I like other than like I
yeah,
don't know, altruistic behavior, why in the world are you stepping in unless you think there's enough competitive bids that someone else is going to step in before you, and it's sort of a race. But you think everyone would be better off, selfishly just letting the whole thing go kaput and then digging through the rubble.
yeah, it's a fair comment. It's a form of like prisoner's dilemma, really, right? Like,
Yeah.
but like you're assuming everybody else will let it go bankrupt, and nobody will step in, even at a loss ratio that's significant for them. So that's why you're playing a bit of that chicken and egg problem. What was interesting to me is like you had that Silvergate self liquidation. You have SVB being under receivership now with the FDIC. I'm not sure if that was just like the main branch or like if that's system wide for Silicon Valley Bank.
Yeah. I don't
But
know.
so I was this morning when I was going to get coffee, I saw the woman that's like the head of our local First Republic Bank, and I was like, oh man, they're probably really happy in this scenario until I got home and I looked up the stock price for First Republic Bank and it's taking a 40%
It
hit as
was like a
well.
massive sympathetic cut across all these regional banks. And
Yeah,
so I ask the question, I go, is it because this is some sort of weird basket hedge that's gone awry? Like, are these things all trading as a basket and then someone got liquidated in some position? If my brain were working, I could probably tell you exactly the mechanics of how this should play out. We're just going to
yeah,
assume there's some world in which they're being used as a hedge against each other, and the unwind in Silicon Valley Bank leads to this unwind in other correlated regional banks. Because I don't know, I didn't see anything that would make you believe that First Republic would suddenly be subject to this. Other than I do
or
know anecdotally, they tend to be very aggressive on their mortgages, and maybe
well,
they're just
yeah,
holding a ton of long duration mortgages the same way Silicon Valley Bank was.
they do tend to portfolio the mortgages, but the difference is, like you're saying, regionally, both First Republic and Signature Bank are very big in California, and so I think it's more the cascade of consequences where people are worried that they were providing like the personal banking for Silicon Valley, which a lot of them were. But like to your point, the reason they're so aggressive on mortgages though is like you have to have deposits across their platform, so
Right.
that's how they're able to portfolio those loans with better rates, but they're making it up on the deposit side. So that's kind of the MO that they've had for the last few years. But like to your point, like if you have a lot of those portfolio loans on your books, depending on what tenor or duration of those, that can could dramatically affect First Republic. But like in just a small way, it's got me thinking about all my neighbors, and I haven't really asked any of them yet. But like but my neighbors with wineries and everything, they use both either Silicon Valley Bank or First Republic. And so I'm sure a lot of them, like you're saying, the FDIC is only up to 250K. Well, if you have your business banking there, that's different. You're going to be above that. So it's going to be interesting seeing how many people locally are moving to First Republic, or people are even scared, like you're saying, the contagion effects of First Republic. Like I said, you and I are not, banking equity analysts or experts. So this is a well above our pay grade. But it's just always interesting to see how banking runs take place.
Yeah.
It's always fear and contagion. Like it's nothing, and then fear and contagion immediately, and that's what creates a self-fulfilling feedback loop.
Bit of a change of subject here, but another thing that caught my eye this week, I didn't realize that the case with Grayscale against the SEC actually went to trial this week. Which it looked like the initial, and again, this is like me reading on Twitter someone talking about what's happening in court. So this is like multiple layers removed.
Right.
And I can't speak to this person's bias, though it was a Bloomberg reporter, and I think they're generally pretty unbiased, having tracked them in the past. It seems like the judges were actually pretty in favor of Grayscale's arguments, that they were sort of saying to the SEC, like, the burden of proof is on you here.
Yeah, I think that I have no hotter take than what you just had. Like you're saying, like it's just like so many things. Normally we don't even cover topically like what's going on the week, but I think like these are all semi-related. Like with Silvergate going down and what's going on with SVB, and then what's going on with Grayscale, and then related to that at the same time. Do you know that today is when all the Mt.Gox claimants are getting released back their Bitcoin. So out of so out of like the 19 billion, only about 3 billion's been recovered, but that all gets released to the creditors today. So I don't know if how much people are front running Bitcoin price. Yeah,
this is an interesting case, right? Because it was 19 billion back when Bitcoin was way lower, right? So you're getting 3 on 19, so what, like 1/6 pennies on the dollar. But I mean, I think Bitcoin's gone up more than 6x. So on a dollar basis, I think it's like it's again, how are people going to denominate their claim? On a Bitcoin basis, it sucks. But on a dollar basis, people might be like, I was made whole.
Well, no, that's a good point. But I think, they're using the 19 billion from today's dollars, but like, so it's still 1/6.
Okay, gotcha.
Yeah, I'm not certain on that, but
I
thought
you were saying it was, that wouldn't even make, this is my brain. I thought you were saying 6 billion Bitcoin versus 19 billion Bitcoin, but there's not that many Bitcoin. I think
it's in today's dollar. I think it was 143,000 Bitcoin or something like in that ballpark. But I think it was more like in today's dollars of $19 billion worth of Bitcoin, they're recovering about 3 billion that gets released to creditors today.
I would love to see a graph of where those claims were trading over time. Right, we've talked about in the past where the FTX claims are trading, which actually I haven't heard in a while, but they seem to have settled around 15 cents on the dollar and really never moved. I think there's a huge amount of complication there in terms of what are you even pricing that in, given you've got multiple cryptocurrencies and multiple international currencies, and how's that all getting unwound, and what date are we striking prices to, and blah, blah, blah. But I'd love to see with Mt.Gox. I mean, how many years ago was that? 7, 8?
Might even be longer than that. And like, shout out to our buddy Tom Brazil, as like he was the one, like tracking all that and paying and figuring out what price to pay for those claimant tickets. So I wonder if he's got an interesting conundrum today, right? I would assume like he's one of those creditors. Like,
I'm sure he's got a great weekend planned, because I know he did very well on that,
Yeah, but also related to that though too today, and to me all this news is semi-related, which is why we're actually covering something topically this week, is that did you see Stripe raised $6 billion? And so
that was the other one that I don't know if it was late last week or whatever, but I saw something effective like Stripe didn't have enough cash on hand, which seems like not objectively, just outwardly with no view inward. Like, they seem like a very successful business, but I guess they were just massively short on cash.
Well, the biggest, so it's a little bit of cash buffer, but also over half of it's being used for stock employee compensation with options in their tax bill. I think the tax bill is like 3.5 billion because they didn't go public. Yeah. And so it's to settle like the tax bill on the option. So this is related in the sense with, you got SVB going down, Silvergate auto liquidating or using their liquidation function, and then at the same time you have Stripe raising $6 billion, which is one like the biggest raise in recent history, and all of this, and then that's to cover the options. So it's all interrelated to me is on these private assets, whether it's PE or especially VC. Like, you can make up whatever marks you want, and you can keep marking up all of these, but eventually your bank's going to have a concern with cash flow. And then more importantly, all this stock-based comp is going to come into the purview now if you have a $3.5 billion tax bill for stock-based comp and pretending like it's not real.
Right. Yeah. How many other very successful startups is this going to hit? Right. And then you got a market environment where that cash is not easy to come by anymore. By the way, huge shout out to our sponsors, Liquid Death. Thank you for perfectly. That was great. Nice.
Is it fully blurred out today? Yeah, no,
I could see. Like the skull was there, Liquid Death was there. It was well done.
Nice. So a couple of other things semi-related to what we're talking about. By the way, all it does, honestly, for me, it makes me really excited about the 2024 vintage of angel investing. Like those multiples coming down, like rationality setting in.
2013 angel investor that's still waiting for their money back. I am not excited ever about angel investing, which probably means it's a great time to angel invest.
Right. Well, it's because you like liquidity, like the simple things. Like, it'd be interesting.
Man, I just had a kid. I need the cash. Do you know how expensive diapers are? I need my Canva stock to go public so I can afford diapers.
So at the same time, Slootman from Snowflake was on Twist on This Week in Startups, And he, you know, is a very aggressive CEO, known for like sometimes I think even J. Cal calls him like the general salutman or whatever. But he was talking about, you know, these companies that are, you know, we've talked about the name reduction in force, which is just nonsense. Like you're firing people. But his argument was these people that are all of a sudden having to do these double digits, like firing or reduction in force. He's like, you were never running your company properly. He's like, we gradually are always doing that on not like either adding or subtracting to our employee count because we're trying to, you know, operate the business in real time. And basically saying that the largesse of these tech companies and their collective fear of upsetting the employee base or Silicon Valley at, you know, writ large with firing employees that weren't performing, and how much, you know, has that been opened up by, you know, Twitter or, you know, I think it was interesting though that his thing was like, no, they should gradually be doing it. It was a little bit more nuanced of an argument.
Yeah, I've got 2 thoughts here, 3 thoughts, because my brain is not working. My first thought is, and we've talked about this in the past, the idea of employees as sort of as a cog in the just-in-time processing machine, right? And how much should, during a bull market when cash is cheap and companies can grow really quickly, should companies be looking to acquire employees, especially star employees, right?
Right.
And then how much value is there in saying, even if it's not a high producing employee during a bear market, they have valuable intellectual property that we want to protect from going to a potential competitor, right? Because one of my thoughts is like, man, it seems like there's a really interesting solution if all these companies want to go to just-in-time employees to be that just-in-time hiring force, right? There's all these temp workforces you can hire from, but not really for like high quality white collar tech workers. That seems like an interesting little niche, but it probably wouldn't work, right? Because Google doesn't want that employee to be there for 11 months hacking out code and then going right to Apple, right? And then going right to Microsoft. Like there's some value in retaining employees who understand IP, even if you're going through a cyclical trough. I think that shouldn't be understated, right? Like it costs a lot to hire, it costs a lot to fire, and there's an asset value culturally, intellectually, that it is beyond just the revenue production of an employee that you might want to hang on to structurally for your business, even if that part of the cycle sucks. I had a third point, but honestly, I have no idea what it was.
So speaking on that, temporary, you know, white collar workers. Have you ever messed around with TopTal? TOPTAL, where like
I've heard of it. I've never used it myself.
Yeah, I mean, I've heard, you know, it's always hard with temporary employees, like you were saying, but I think also I've heard some good stories about people hiring, you know, like a McKinsey consultant or a former, you know, Fortune 500 CFO or something like that on a part-time basis, because that's at least like TopTal is trying to vet that upper end or that upper echelon, and so we'll see if those work out over time. But like I said, it's always hard when running a company, you know, permanent versus temporary employees. But also, this kind of like ties back into our macro. It's like, but in the comments, Brian asked like, how many short sellers report or other regional banks are in the pipeline now? Is like, as you know, like, I'm sure this is getting, if you had time to look at them this week, like you're just getting a flood from like the investment banks and all there's newsletters of all these like these short selling reports and all this deep dive into the regional banking stocks. So now if you were in global macro and you're being that dilettante, now all of a sudden you'd be an expert on California banks and you'd be telling me which bank to short right now. And I just think like, these things are always so far behind. And related to that, sorry, before you get in there, is like Convex Asset Management, no, as random topic, office space short. And I think it's just been in the writing for a long time now that how bad the San Francisco office market has become. So once again, whether that's those regional bank shorts or the office space short in San Francisco or the Bay Area, are you too late? Like, is that already baked in? And by the time we're already, you know, discussing on a ridiculous podcast like this, you're way too late.
Well, the thing about way too late, I think sometimes the degree of early or late has to do with the difficulty of the trade. So how do you play an office space short? What do you think the best way to do that is, Jason? Through the equity of, you know, commercial mortgage-backed lenders? Like you can't, you know, I can't show up at an office and say, lend me your office to sell this building and I'll return it to you, you know, like when you call it. Like that doesn't work.
Yeah.
Right. So what's, you know, is it the mortgages themselves that you think there's going to be a default on, or the value is just going to decline? Like what's the best way to play that short?
That's the hardest thing in real estate is like you can't really short it. That's the biggest problem.
Right.
So
And whenever you have a market, right, that isn't easily shorted and super liquid, like by definition, it's not Jason, my brain is not working. It's not efficient. Oh my God.
No, like to
What
your
an
point,
easy
like
word to say, and how my brain was like going to retrieve it and like, no, just not coming up with anything. Yeah. I mean, but like when you see markets where they prohibit shorting, you get very weird bubblish behavior. When shorting is very difficult, it makes markets, people can only go long. And you saw that in China. You saw what happens in US markets when you prohibit shorting. Like shorting is a valuable behavior in terms of suppressing bubbles and providing a cushion on the downside because they become natural buyers when prices go down. When that doesn't exist in things like real estate, I think you're more likely to see bubble behavior. Now, when you introduce real estate derivatives of sorts, I think that can help sort of meter some real estate price behavior. But it's always interesting to sort of think about these different asset classes where shorting isn't easily achieved necessarily.
Right. Well, because you're saying even those derivatives that just the liquidity isn't there, and then like you're saying, without that ability to short efficiently or effectively, and as you and I both are not huge fans of shorting equities, just because of like how you can absolutely get your face ripped off, because it's just the dynamics of the way that it's structured to be able to actually short equities is. It's also makes it so it's just a Tina effect, right? That like this is why housing always creeps up or CRE always creeps up, because it's very difficult to short it. There's not a lot of bets on the other side of that trade. But one of the things I wanted that leads me nicely into that is like we were by the way, before I forget, because Sean commented too about transaction costs, and that's what you were saying with hiring. And like if you ever read like Ronald Coase and all of his like Nobel Prize winning research, it's basically that's what you're dealing with building a company is the transaction costs, and it's about hiring and firing, and what are the transaction costs of bringing a corporation together, and what does that look like even in a modern world of gig economy? There's still transaction costs either way, right? It's just you're trading off one transaction cost for another.
We talked about this a couple episodes ago with the Goldman Sachs workforce reduction, and that the amount of salary they were letting go, like versus the compensation they were paying for people who were leaving, it was going to take them like a year and a half to 2 years to recoup that actual value, because all the comp they were paying on the way out the door. Just the reality is like hiring is expensive to find the right people. If you do it correctly, you got to take time. There's all sorts of bonuses and signing packages and all that stuff. And on the way out, if you want people to sign any sort of package about not suing you or mutual release or anything like that, it costs money. So a lot of or you owe people their paid time off that wasn't all that sort of stuff. Like just it is expensive to hire and fire, and so there's a transaction cost to running a business. By the way, you mentioned Tina. I have thoroughly enjoying all the new versions of Tina that are coming out. So so from Goldman Sachs, I saw this yesterday. So Tina, there's no alternative. Tara, there are reasonable alternatives. Tapas, there are plenty of alternatives. Tierra, there is a realistic alternative.
Oh my God.
I mean, I think everyone right now is like, they saw the way Tina took off and they're like, oh, now's my chance to come up with the new Tina and be the person that like defines the next decade.
Man, all I think about is Tina Turner and Tina at More Protein Bars whenever I hear Tina. So shout out to Tina More Protein Bars. Unfortunately, I was actually supposed to be with them last night for doing the stock slam, but we had one another. It was atmospheric rivers here in the Bay Area, so I didn't unfortunately leave my house. So I was really sad.
What is an atmospheric river? I saw you text me that saying your internet might be out. I have no idea what an atmospheric river is.
So that's what they and now this is once again, it's just like global macro, right? We get to learn a new word, and now we get to pretend like we're experts, and we're just dilettantes, right?
I'm not pretending. I'm asking.
It's basically when you just get rain dumped on you endlessly. For like an extended period of time. What we used to just call a bad thunderstorm or a bad storm is now an atmospheric. Yeah, because it just keeps
rebranded thunderstorms.
Yeah, in California, that's what we're good at in California. By the way, speaking of rebranding, I'm sure if anybody in the Booty crew had mutual release on their bingo card that you just said, that was quite the good one. I'll just have to remember that one. That's gonna have to go in our catalog of Booty crew phrases. But okay, so talking about real estate, I actually was talking to.
I just got that. Okay, I'm with you, man.
Yeah, you said mutual release. So A friend of ours I was talking to the other day, and he just brought up, he wanted to get my hot take on housing, which, I don't have hot takes, but just given my background in commercial real estate. And one of the things I was pointing out is like, if you run a commercial real estate fund, company, development, whatever, like you don't have the choice not to buy, right? It's really your only choice is not to buy. But this is exactly why institutions allocate capital to you, because they're expecting you to fulfill this niche and to keep buying. So what do you do in that scenario? Okay, you can hedge your interest rate risks, which we've seen, some of those, articles coming about, but we didn't know what the total AUM they were hedging against. And then what you saw is a lot of people, because of just chasing the market downs, cap rates got compressed. You have all these people on YouTube, etc., saying how great CRE is for income and everything. So people then, to be able to pencil out or to underwrite the project, they were having to go to floating rate loans. And so with maybe a 3 to 5 year on the reset. And so now we're seeing a lot of them are underwater if they had to get reset. But at the same time, maybe the ones that were more prudent, that maybe did some value add, maybe some distress stuff, but then, kind of locked in fixed rates, they're doing just fine. And so it's always more nuanced than you think. And one of the ones that came out the other day is like, if you just take the rising rates on the residential mortgage side, I'm sure you've seen this, is on average, and this is why I highlight on average, because you and I both hate this, is you would have to take a 30 to 35% haircut off of today's housing market price on average. But as we both know, that's regionally very different. That can mean anywhere from -10 to -70%, depending on where you live. But more importantly, so I was talking about, obviously the CRE is one side of the business, and people can see the writing on the walls. There's maybe ways to short that a little bit with CMBS or exotic derivatives. You can hedge out your interest rate risk, but those are kind of writings on the wall, and we've seen what the vacant space is in San Francisco. But we don't. One of the things that they can't hedge out the risk on is if you ever have price controls. And so if the economy or politicians get at some point in the future, and I'm not saying this can or will happen, but it potentially can happen, is you can't really hedge out your risk of price controls on the CRE side. But going back to this, on average of a 35% haircut on the residential real estate side, it's obviously very different regionally. But more importantly is a lot of, because of post GFC, a lot of the mortgages people got are 30-year fixed. They're not using as much as the variable rates as CRE was using now on the commercial side. So that has changed kind of the landscape dramatically. And so people that locked in at, sub 3% rates, they're not going to take that haircut. So it's always like, so what would we end up with probably on the residential side is, you and I've talked about, is like a locked market. Like nothing really moves because nobody wants to take that haircut. And I was thinking about this morning is like, it's interesting to me how, most people have fallen for this kind of like net worth lie. Right. And so if you ask the average person that's not in finance or whatever, like, what's your net worth? A large part of that is going to be the net worth in their house. And they're using these marks that are illogical, right? Your house is only worth what somebody is willing to buy for it. And the average person is not going to be interested in taking a 35% haircut in their net worth. And so everybody's just going to be sitting in these like locked homes. And I would assume like nothing's going to move for a while. But I mean, obviously what you and I've talked about is like, I've been around real estate my whole life and I cannot predict real estate markets, but it looks pretty interesting.
One of the things that you clued me into that I wasn't even aware of from a history perspective was that the 30-year mortgage is something that was really invented pre-1920s bubble, something that was hugely instrumental in the real estate bubble in Florida pre-1920s, and is a very unique part of a very unique financial instrument to the United States. Like the 30-year mortgage really does not exist in other countries. So let me ask you this, Jason, totally unprepared. What does the world look like if we got rid of the 30-year mortgage in the US? Like, do you think the fact that people are able to lock in, we're just able to lock in massively low rates for 30 years is going to could create a housing freeze that, hey, if they had a 7-year ARM, would just force a mark to market in a way that would create inventory and turnover?
All right, so many things on this, and I'm just thinking about all the hate I'm about to get for this one. So multiple things is like what we found over time, what you and I have been talking about is, boomers didn't get that. Like now modern housing market is just your monthly payment. Nobody actually cares about the notional value of the house anymore. We're basically, I think millennials to Gen Z realize they're just renting. And so the point is, what is my monthly, PITI? And that's what actually people are going off of, not what's the notional value. And I think that changed a lot. And so you would think with the rising in rates, the PITI change, then people can't afford as much monthly payment, or vice versa. And so that should change a lot. What I get excited about with your question, I'm gonna go slightly tangential. It's like, I don't believe mortgages should exist. I do not understand why we get the banks involved. So like, say theoretically, people are supposed to put 20% down on a 30-year mortgage. If you take away the mortgage financing, houses should be taking 80% haircut, right? It should be what you can afford to buy. The whole point, I don't understand why we have this middleman, this rentier class of mortgages where we have to pay interest to. It doesn't make any sense other than elevating and the prices on homes, because it's just your access to capital and leverage. You're gonna hate that one, aren't you?
That one's tough to digest. You really hit me on a day my brain isn't working. Well, it's funny. I saw a hot take on Twitter. I don't know if it was this week or last week, that someone was just like, credit shouldn't exist. They're like, why? That just drives up the price of everything. When you introduce credit into the system, it just gives everyone more money to drive the price up. It's like a one-time inflation shock. And I was like, that one kind of hurts my brain. I mean, I get the point, the one-time inflation shock. If there's no credit and then suddenly everyone can buy on credit, yes, it's like all of a sudden all that money's fractionally created. But when you're trying to start a business, borrowing is kind of nice. Debt is kind of nice, right? So it's an interesting case, though. Like, why do you need to have debt in the housing market? Well, just maybe for a house, the costs of goods, like there's no way to replicate, right? If the cost of extracting those natural resources is X, and you're going to have to build the house for Y, no one can afford Y. What, we just all end up in like shanties? I mean,
no, like I think
like there's a replacement cost of a house, right?
But yes, but that's all. It's a circular, right? It gets inflated by the ability to leverage your house as well. Like it all feeds back into each other. And I'm sympathetic to Richard Werner's idea that we should only be lending to entrepreneurs. Like, you shouldn't really lend to housing and stuff, because this is what creates these locked markets. It's what creates these feedback loops that just exacerbate like an inflationary pulse, where you should be lending to almost destructive capital entrepreneurs. But imagine the banks trying to flip that idea around. That's like an impossibility probably in our country right now, unless you did have a true housing crisis. Then you could potentially like reset this whole structure that's been accumulating.
Yeah, I mean, look, I'm not sure mortgages are ultimately the problem in real estate and causing bubbles, and I am by no means an expert, but you can just look in Canada. They have their own real estate issues that have nothing to do with the mortgage.
Well, they have a bigger problem because they actually have recourse financing, where we have non-recourse. But also, yeah, like you said, it's nothing ever is quite that simple. It's like, if you also have to add in home insurance too. Like if I can put $1 million down to buy a $5 million coastal property, the only reason I can do that is because I have insurance.
Right.
Like that, there's all these reasons, they all feed back into each other. So yes, it's not just simple as one thing triggers the other. It's always a very, very nuanced, complicated picture.
So related to mortgages and mortgage pricing, I want to talk about bonds for a second. So first of all, absolutely wild day in bonds today. I have no idea what is driving it. You saw the 10-year almost touch 4 earlier this week or last week. Again, I've lost all concept of time and space and reality. But recently it almost hit 4 and then has since plummeted today. Massive action in the curve. One of the other things I noticed, though, like the implied overnight rate and number of hikes or cuts priced into the front end of the curve by the market, month over month, has changed dramatically. I mean, you had, going into the end of 2023, a month ago, I think it was like 1.5 cuts were priced in, and now you have, I think it's at least 1 hike priced in still through the end of the year, right? I mean, absolutely like manic market behavior. And at first, when I was looking at in the last week, I just said, this smells to me like someone blowing up. And it's a little hard for me. Again, I'm not paying attention close enough day to day, but it's a little weird to me to see all the regional banks blow up, who would be, right? You have that short versus long trade. They should have been hedging, right? You would expect if someone of magnitude is blowing up, there's going to be an impact in those markets. The same way we saw when the UK, their pooled pension levered vehicles started to blow up. You saw UK rates blow out. You would expect some sort of behavior. And again, I'm just going off the top of my head. I need to figure out the direction you would expect that. But seeing wild swings, I'm not I'm not sure if those are linked. No one's really talking about them being linked. But this other side of it, which is the price of hikes versus cuts in the market, is like wildly manic lately. Hot take, Jason. Give it to me.
Man, you really set me up for a nothing burger on that one. Is like, oh my god, people predicting the future has a large variance to it.
Well, what I think is sort of crazy is like, and maybe I don't know. I generally again think the market is mostly efficient, but like Powell has been very clear. He's like, as long as inflation stays high, we're just not cutting. And everyone's like, you're going to have to cut. There's an earnings recession coming. And he's like, I don't really give a shit. I'm not cutting. Like, I want my legacy to be that of Volcker, right? At least that's what it seems like. And I guess the market's playing chicken with him and saying, no, you actually are going to end up cutting. And then PCE came in pretty hot. And then all of a sudden, oh, he's not cutting. And then was it NFP today? Again, I don't know what date today is. NFP came out recently, right? And all of a sudden bonds are taking off again. It's kind of wild. Like the market can't make up its mind. All this like focus on being data dependent really leads for some wild swings on data days.
Yeah, I mean, I think we've seen that going back to Q4 on data days, and that's why even the 0 DTE was a lot of it is around data days, and now nothing seems to matter more than CPI releases or, like you said, non-farm payroll, or anytime anybody wants to talk. Those seems to be the days that people want to trade on. But other than that, like in general, I like the yes and everything you say. But man, you couldn't have picked a topic that I couldn't care about less.
Yeah, okay.
And just like no, but
well,
I got
let me pivot to 0 DTE then.
No, I don't want to.
No, this one actually, I know you're going to have some interesting because it's not really 0 DTE, but it just makes me think. Our buddy Ben Eifert at QVR recently published a piece, or QVR at large published a piece. I don't know if he authored it, about now that there are weekly options, you can create this gamma index, like basically buying a weekly every single day and rolling it. I think it's in tranches of 5. There's a new gamma index that exists, I think, published by SIBO, that you can go look up and get the historical returns of. And he's basically saying, like, the way that people used to be able to buy pure Vega, and you can, with something like a VXX, they're now, like, with these options, you can get something like that's like pretty much pure gamma exposure, which is kind of a cool innovation.
Yeah, and then you could start playing around with, offsetting things with implied versus realized and all sorts of that stuff. But once again, like, just like the Vega products, it's a, how do I say this? It's a proxy, or like an aggregate proxy. And so therefore, like, be very careful, know what you're buying, know what you're working with, whether you're, doing a pairs trade with it and, or, going long or short, like, just know what you're doing. Because it's not it's a map, not necessarily a territory. That's what I'll say about that. But I'm glad we have more tools, though.
I haven't spoken to Ben about it yet. I wonder whether he sees it as a hedging product, a trading product, or a structural allocation. I suspect very much not the latter, right? That he would see it as a way to sort of, dial in your gamma exposure, or at least on the S&P 500. But it'll be interesting to see if anything, gets launched to track it.
I think there's going to be, I think you and I both know there's several products in the wings that are going to be launched to track it. So
listen, man, I just like to throw it out there,
Yeah, exactly. We'll see. Like, I like the insider knowledge. But by the way, that reminded me of both Meb when we were in Salt Lake, and then Jay Kell saying too, is like, how private markets like are all about insider information, and that's what's legal. But then public markets is the exact opposite. It was just I'm always fascinated by those type of things. But to change subjects on you too, on Odd Lots this week, they had, they wanted to talk about earnings and businesses, especially like in consumer packaged goods or, groceries, etc. And one of the things they brought up on earnings was PPP, Pepsi pricing power, and how it was price over volume, as people cut volume to increase price during the last few years. And though, so I think what's interesting, like you were just saying, the taking Tina into other categories, is this PPP thing's really catching on. But I think it's really coming from the Pirates' pinky promise. Now,
yes,
for those of you in the Booty Crew, is we like to think we work for free, but we work for you. This is an agreement. This is a Pirates' pinky promise. We put out this content so that way you'll like and subscribe, especially on YouTube. We want to see you hit those notification bells so you don't miss the live comments. For those of you that are listening or watching after the live content on a Friday, you are dramatically missing out on the chat of the Booty Crew. It is so much more entertaining than Corey and I could ever be. But part of that Pirates Pinky promise is you got to like, subscribe, turn on those notification bells. This is the agreement that we have here. Even with Corey, relaxed and his snarky, newborn baby face, like he knows the importance of this promise. Like we're here for you, and we appreciate when you're here for us.
Yeah, as Sean said, that was a long walk off a short plank to get to the PPP setup.
No, I'm bringing it back.
But it's an important one.
I'm bringing it back. No, it's interesting. This idea of price over volume, and then people using macro excuses to raise prices. As a business.
So explain
owner,
that to me. Why was it Pepsi specifically, or is that just like they like saying PPP?
He liked saying PPP, and then they brought it back to Coca-Cola and other brands that have decided to go for increasing prices and reducing volume, knowing that when things turn back around, they'll have sustained a higher level of prices, and they'll push that through while people were feeling like more rich. And that's the idea too, through wage increases and or different things that have gone on for during the pandemic, whether it is the traditional PPP loans, et cetera, is they're passing through these higher prices when they think people are accepting of them. And they're reducing their volume, and then over time they'll keep the higher prices and increase their volume. And like they're saying, they're using all these like Ukraine, wheat, red winter wheat prices. Any macro excuse they use to raise prices is great, but like as it's kind of interesting conundrum as a business owner. You're always thinking, how do I raise prices? How do I keep up with inflation, et cetera? And most people don't want to see you raise prices, but as soon as you have an excuse, people love a narrative. And so people are using these excuses to pass through prices. And there was even one like Wingstop was great. Wingstop they've been raising their prices for the last years by like a 2 to 3% increase, like on average, even now, like as we're settling back down. Meanwhile, chicken wing prices have fallen by 50%, but they're still increasing their prices by 3%.
So I was gonna ask you about that. Like, how much of consumer felt inflation ends up being businesses using the accepted inflation story narrative as cover to just raise prices? They don't have to raise prices, but they're like, oh, everyone thinks we're going to because of inflation. This gives us cover to. It kind of reminds me of Bloomberg and their contract for their software. Yep. They actually they increase their prices with inflation, and you're like, what the fuck does software have to do with inflation? Like, just because eggs are more expensive doesn't mean I have to pay more for my Bloomberg. But you do.
but you do, because they can put it together. And like you were saying, it's like now Walmart has gone to a $14 an hour wage rate. So essentially that is what we think about as minimum wage, right? Whatever Walmart pays is what's going to establish that baseline. So they're saying, does the consumer feel wealthier with those wage gains? And like you said, it's this self-fulfilling psychology of inflation, right? The more people feel it, the more people think about it, the more people talk about it, the more the news talks about it, has all these like self-fulfilling processes. And they were saying, interesting, by the way, when you brought up eggs, they were saying allegedly, this is what they said on Odd Lots, that during this last holidays was the first time we could truly get together. So people were going ham on the baking. And so everybody's using way too many eggs, but like everybody says they're egg shortage, but people are consuming like it was like 2 or 3x the normal amount of eggs during the holidays. Everybody's really stocking up on eggs that's
pretty fascinating.
I don't know if that's true, but then
I like the narrative.
But speaking of these narratives, the psychology of, I wonder if like the psychology of being locked up, and now when we want to get out, we want to go out to eat, we want to order, DoorDash or Uber Eats and all of these things, and we want to feel differently about ourselves. But like, the idea around behavioral economics it's interesting to me. At the same time, whereas everything is behavioral economics, at the same time, behavioral economics is bullshit, because like you can't track or figure out any of these things, but it is all behavioral. So it's almost like water. So I'm not sure it's like that interesting to talk about, because we're just creating more speculative narratives. But the one I was thinking about is like, I wonder how much we almost brought forth our specialized lives now. Like we've gone into deeper and deeper specializations with where everybody works. And so part of that is, you're working more, you have a specialized life. So like you're so stressed out at work that the DoorDash or Uber Eats, et cetera, just becomes like your baseline, especially over the last few years, where we pulled that forward, where people are like, oh my God, now I'm paying, $30 to get like a dozen eggs delivered with all the add-on fees and everything. And they're going, I should really cut this, but nobody's cutting it, because like they're so stressed out in every other part of their specialized life or whatever that they can't They don't want to cut on those what now are deemed as necessities for living this very integrated online, internet style life.
Do you think specialization is like an eventuality of capitalism? Like by definition?
What's the quote? Specialization is for ants. Yeah, I think I generally I see where you're going with, like, it is an inevitable outcome of capitalism.
I was thinking about just like not even just like the knowledge economy idea, but specialization in the knowledge institution, right? Like colleges, and you think about the way work builds on other work. I saw this great comic that I wish I could remember it, but it's basically someone talking about doing their PhD, and there's this massive bubble of knowledge. And they were talking about how their PhD was like going to the very edge of the bubble with the sole goal of just like nudging it slightly out, right? Just in that one tiny point of the grand knowledge. And as you continue to build in these fields, the knowledge requires more and more training, more and more schooling, more and more education, just to get to the point where you're now in a new frontier, right? There's all that base to learn of what came before you. I think somewhat the same way with, like, weirdly enough, like, I think capitalism in many ways drives people to specialization during periods of stability, right? During instability, it's a bad thing, but specialization is optimal during periods of stability.
Right.
But like, I also think, like, the more we are a knowledge economy and we rely on that specialized knowledge, it requires someone to go to school for that period of time, right? To work on these hyper unique drugs that we're developing, or whatever it is. The technology just, it requires more schooling and more know-how.
Like you said, that's intertwining maybe like capitalism with like the internet age and the digital economy, but like, I mean, they're one and the same in some respects. I think about it a lot in the sense of like, it's a form of extended neoteny. So as mammals, we have this incubation period, like post birth, where like you're going with right now for the first 2 years. A human mammal has zero ability to take care of itself, feed itself, any of those things, right? Where if you see like when a fawn or deer is born, they can kind of walk pretty immediately. Like they don't have that extended neoteny period the same way humans do. I'm not going to get into why all this extended neoteny for humans, but I think there's also now a psychological or a philosophical extended neoteny is what you're talking about too. Is like, as we're allegedly living longer, and we'll see if that's the case or not, is you have to have this specialization to compete in our capitalistic economy. And so part of that is you're going to stay at home longer. You're going to be educated longer. You're not going to probably, people are getting out to even start in the workforce and taking their first paycheck in their mid 30s now. And people are really getting upset by that. But like you're saying, it's all multiple forces of complex system interacting, where this is where we're headed, and that should be more acceptable, because like you're saying, compete in a specialized world, you're going to need specialized education, because you need to entertain people in a specialized way, which you're going to have to drill down to find your niche.
Well, the one way to think about this, right, is if there's just more. So here's a weird way to think about it. And maybe I'm wrong. Maybe this is arrogant of me to say as a modern man. But if we know more today than we knew 10 years ago, than we knew 100 years ago. If you want to be a generalist, you have to spend more time learning, right? So either you have to extend the learning runway, or if you want to keep the same learning runway, you need to specialize earlier and accept that there's going to be a whole bunch of stuff you don't know, which leads to greater specialization in the economy, right? And I'm not sure what the right answer is. What we do know is that typically during periods of stability, people lean into that optimization, right, and specialization. And then when things get shaken up, people don't have the skills to move laterally into other areas, and it's bad for everyone. It's suboptimal to not have some generalization of skills. So I don't know if there's a good answer. I think there's certain things, like, I'm sure incredibly nuanced chemical research, drug research, scientific exploration of the universe. Like, I'm not sure you can shortcut that if you're building off all the prior knowledge. You just need to spend the time in school, and every year that goes by, there's more and more knowledge that's being built. So you either need to stay in school longer, or take that specialization path and just accept there's going to be things you don't know.
Right. Like, you shouldn't, Jackson Pollock's not interesting unless he can paint like Goya first. right? Like you have to go through that knowledge base before you can really create something, tangential or slightly unique.
Well, that's why we do
Related-
macro, because you don't need any knowledge to have micro takes.
But part of that too is like, so going back to like generalization, this is actually I really wanted to bring up with you. It's the idea of branding. I was actually just watching your boy Nick Bear, who's changing up his podcast. He's no longer the CEO of Bear Nutrition, and he's working on these other projects. By the way, he admitted that he was deeply burnt out, which is, wow, big shocker based on all of the output he does. And part of it for him was having a kid. So I can't wait to see kind of the trajectory you're on. But part of the branding picture is like that generalism, right? Is what I would bring it back to, is like thinking about, Peter Thiel's, 0 to 1, great book. But one of the things he, talked about moats, was the moat he didn't understand was brand. And I think that in a specialized world, right, where part of that specialization is we're all on a form of like the autistic spectrum or Asperger's spectrum, is like branding then from a generalist is a way to differentiate yourself in a world that maybe Chat GPT-3 or other things are going to narrow niche down into higher forms of specialization, where the idea of branding is so nebulous and is more of a feeling, or for lack of a better term. I'm just curious how you think about that. Is like branding now becomes a way to differentiate yourself if you can figure out the nuances of branding well. And especially in our side of the business, I think there's still tremendous opportunity on the branding side that most people generally miss.
I mean, I think that I think branding is hugely important. Ironically, I think sometimes it's the thing I'm the worst at. But I think branding is massively important and becomes even more important in a hyper-connected age where the barriers of people finding you can go down materially if you have a strong brand, right? We've talked about this in the past, where like it makes sense for celebrities to have their own assets now because, they don't have to go but take out a page in a magazine and compete with large company advertising spends. They own the advertising space via their social media presence. So I think personal brand and branding becomes much more important. I think for employees, it's very important. If you're a high skilled laborer, if you have a strong personal brand, it'll make companies pay more for you to have that sort of halo effect around who they have at their company, because that attracts other talent to them, like a magnet. So I think there's tons of value for people thinking about that personal brand. I had so many other thoughts on this that have now just completely escaped me.
Well, part of it is it's this. There's a great Caribbean writer philosopher, Edouard Glissant. I think it was originally from like Martinique. He talked about the right to opacity in a lot of different ways, whether that's from on the human level to all these other levels where, not everything is legible and can be understood. And I think there's a certain opacity to branding that's very hard to nail down. And that's why it does offer that moat, because if you can get it right, which is incredibly hard to do, you can really be a differentiator there. But how do you manage people's perceptions of a brand? It's almost like the problem where like not when I'm picking up on your brain farts, is the I'm
don't blame this on me,
is the beauty pageant problem, right? Not voting on who's going to win the beauty, like not who's going to win, but voting on who the people think will win. And that's part of that opacity with branding is it's people's perceptions, and perception's not reality. And so you have to think about what people's perceptions. So it's like second, third order effects. That's why it makes it exceedingly difficult. But while both of our brains are misfiring, we're getting up around an hour, which I'm, by the way, just mazel tov to you. I did not think you'd make it this far. I didn't even think you'd make the show today. So tip it off of the cap to you, my fellow pirate. But there's three things we didn't get to that I want to kind of leave cliffhangers, because I think this will actually be maybe multiple episodes about. So obviously we're going to think of, as you progress with having your first child, I can't wait to beg a lot of questions to you to see what your hot takes are in general. And it's going to be fascinating to watch that go along. But part of it, when I was telling about Silicon Valley Bank today in First Republic, is seeing some of my neighbors that like run the bank, like the local branch or whatever. I was thinking about the difference between small towns and cities, right? Like I know who my like local banker is, right? Like we have a no wait ER that's just up the hill. It's 5 minutes away from me. Like, and if I need to get a passport done, I can just go right into the local post office and there's no wait. And so there's a lot of like bonuses from living in small towns. But then sometimes we crave the city. And then I had a lot of these things you and I talked about when I spent, a bunch of time in Philadelphia that was both good and bad from being in the city again. But I think with you having a kid, I think we get to explore more small town versus city, but I also want to one of the cliffhangers for you is like, I think sunshine really matters. So choosing whether small town or city is the sunshine is going to really affect the ability to enjoy that small town or a city, which you know all too well. And then the second one that I don't think we talked about before was on this whole series that Top Traders did with trend followers and everything. They had Nigel from Quest on, and Nigel was talking about how higher Sharpe ratio proportionally means larger drawdowns. And so I was texting with Nigel and the Quest team right after, because he said they were talking about like the difference between, you know, MAR ratio and Sharpe ratio and variance versus max drawdown. And I wanted to see if they had any data on it, because, you know, that's quite a bold statement to make.
That is a bold statement, because if returns are normally distributed, by definition, drawdown is smaller with a higher Sharpe ratio, which we know. We know,
right.
We know.
But that's why they said just look at the correlation of, you know, realize, you know, max drawdown or expected drawdown, knowing that positive skew will have lower expected drawdown as a multiple of all. Example, S&P to 3 to 4x versus CTA around 2x. And like we've had like higher Sharpe ratios in S&P and lower Sharpe ratios. And then we can start getting into Sortino ratios, Ulcer ratios, Serenity ratios. But this is more of a cliffhanger for next. Sorry, you were going to jump in.
No, I just wanted to say, I know you think I'm slow today, but don't think I'm so slow that I didn't notice that little like, oh, I was texting with Nigel. Like,
okay. More his team than Nigel. Nigel doesn't.
Okay.
Nigel's not responding.
Okay, nice name drop there, buddy.
The team at Quest. Like what?
Yeah,
what
that's
a
interesting.
Great,
so there is.
Too.
I have seen. Yeah, great name. I remember what I wanted to say about branding, but there was a paper that actually showed expected returns are not related to vol or variance, but actually related to skewness. So there might be something to that, right? Where if your Sharpe is just the first two moments of the distribution, expected return and volatility, and you're ignoring skewness and kurtosis, and the expected return is actually compensation for skewness, while higher skewness for assets might actually be lower vol. It's like that, Taleb's turkey, very constant, and then a huge sell-off. That's why you have a high Sharpe, is because the expected return is so high because of that hidden skewness. So I could absolutely see there being something to that. Now, I think it's a question of, is that intrinsic to assets? Is that intrinsic to trading strategies? Like, what is that intrinsic to? Rewinding, and again, I normally wouldn't ignore this, but I'm remembering what I wanted to say about the marketing. You mentioned ChatGPT. Was recently working on something with a friend where they wrote a paper and wanted to do a whole set of tweets about the paper, and was too lazy to come up with the tweets. And in fact, wanted to write some paragraphs in the paper that they were too lazy to write, and asked ChatGPT to write the paragraphs. And then afterwards fed the paper into ChatGPT and said, create a tweet storm out of this. And then didn't like the way the tweet storm was written and said, okay, use more emojis. Use less sophisticated language. And it was able to then, ChatGPT was able to take the paper and I'm air quotes for those who are listening, understand it enough to pick out the salient points when fed different paragraphs to come up with little tweets of the right length that would be like a nice tweet storm summary of the paper. It was pretty impressive. And I think things like, ChatGPT still has a long way to go, but it gets me so excited to think about how in your day-to-day people will be able to use that as a productivity hack. Mm-hmm. What I wonder about is, does that lead to this subtle convergence in voice, right? In the way things are done, in the way things are written or spoken or marketed, that those who stay natural, non-AI augmented, actually have a long-term potential edge because they can maintain a unique voice, right? To tie it back to markets, it makes me think about when everyone in the industry adopts MSCI BARA as the standard risk model, and then all of a sudden all the quant strategies collapse at the same time because they're piled into the same stocks because they're using the same risk factors, right? When something gets adopted as a standard set of practices, how does that potentially create fragility?
Man, there's so many things in there. I wanted to end, but man, I got to touch on some of them. One is, that's it. Like we were talking about the specialization or whatever. Like I think about like the advent of non-regional diction, right? Like everybody's losing their accents. Like to your point is like, so then do we lose our accents and unique abilities online to communicate? And like you said, somebody going in a divergent path will be clear that they're different, but for all the slings and arrows that also might come with that. And it's fair, and it relates back to what we always talk about sometimes is like alpha is just undefinable beta, right? It's like a Kuhnian scientific revolution. It's just like we haven't found the reasons yet. We haven't found the beta yet. And so you always have these pops up like where you cannot use technology to figure it out because it's already been modeled, especially with like CRISP, theta, etc. By the way, I can't help myself just because Brian put it in the chat. So that's not usually true in bond funds. At least we see plenty of high Sharpe ratios with low drawdown strategies. And I would caveat with so far, right? Like that max drawdown is always ahead of you. But yeah, I get the general point, but that's what makes me nervous. But like that was your point, is like you need to dive into that asset class and strategy and just think if we haven't hit max drawdown yet and where the skewness is maybe hiding. And once again, this is another form of human plus machine, is we can think much more creatively of where that max drawdown may be hiding, because it's not in the data set that we're feeding into the machines to operate, figure out an optimal strategy. With that said, once again, happy baby little pirate. Oh, look at Tyler put up there. Oh, that's so perfect. That nice, is awesome. Tyler. That is awesome.
I'm sure that was AI generated too.
By the way, the PPP, the Pirates Pinky Promise, is catching on. We see you out on Twitter, Booty Crew, and everybody fulfilling their Pirates Pinky Promise. But as always, it's just it's a promise between pirates. We're just trying to help grow this channel. We're trying to get some new diapers for Corey, baby pirate.
Support my family.
Baby needs a new pair of shoes. Other than that, this is not investment advice. This is for educational or entertainment, not educational or entertainment purposes only. Please seek out professionals for advice. Otherwise, hopefully we'll be back next Friday, 3 Eastern, noon Pacific, for another live episodes of Pirates of Finance. Thank you for joining us. Corey, thank you for making it. I appreciate it.